Thanks for joining us on. This is Bloomberg Quint. I'm Harsha Subramanian.
Good afternoon. I'm Ira Dugal. Let's get to the headlines. Indian equity benchmarks edge higher. Gains in Kotak Mahindra Bank and Bajaj Finance get offset by losses in HDFC Bank and ITC.
Oil sinks from a 3.5-month high after Saudi Aramco says it revived 41% of capacity hit in the drone attack. Brent is back near $64 a barrel.
Lenders to DHFL plan to sell the company's stressed corporate loan book and take control of the remaining retail assets. That's a Bloomberg Quint exclusive.
And investors await the outcome of the FOMC meeting tonight, where it's widely expected to cut interest rates again.
All right, let's first take a look at how markets are faring. Yesterday is here with us.
After Neera, and the opening of the market was quite weak, but after it was announced that the finance minister would be briefing the media on the cabinet meeting takeaways at 3 p.m. today, we saw some good spike in the markets. 40 points up on the Nifty at this point in time. The advanced decline ratio also post that announcement improved significantly. Right now, we are almost 35 stocks gaining on the Nifty 50 to 15 declining. On the top gainer side, we have the metals pack, which is doing well in trade. So we have the likes of Tata Steel, Vedanta and JSW Steel. All of these stocks gaining anywhere between 2.5% to 3%. SBI also looking strong, almost 2.7% gains coming in for that, along with Bajaj Finserv, which announced their plans for a QIP. So both Bajaj Finance as well as Bajaj Finserv are quite active in trade. On the losing side, we have Britannia, which is down 3%. ONGC, Coal India as well as ITC are the other top losers on the indices at this point in time. If you look at the oil marketing pack today, that is also quite active after the crude oil prices fell yesterday post the Saudi Arabian announcements regarding restoration of production to a certain extent. Crude prices fell, and probably that is the reason why all of the oil marketing companies, BPCL, IOC as well as HPCL are gaining in trade on decent volumes.
Yathin, thank you for that. Let's move on now. The markets are cheering the fact that Brent pulled back from a 3.5-month high to trade near the $64 mark, per barrel mark. This after Saudi Aramco said that it has restored 41% of the capacity damaged in the drone attack. Speaking to Bloomberg's Aramco CEO Amin Nasir assured that the facility will be back to full capacity by the end of this month. Listen.
Project management is a strength for Saudi Aramco. We do mega project all over. So when this happened, immediately after doing the assessment overnight, we have put our workforce. We have subject matter experts, engineers, professionals, the operators, the craftsmen, and we worked in barrels on each train that was impacted. So each train had a full team working on it from A to Z to restore it as a project by itself, and the manager of operation of Abqaiq plant was given full authority to execute with availing all the resources required for him 24/7. So that helped us to put the facility back on stream.
And when will that be back at full capacity at Abqaiq?
Abqaiq will be at full capacity, of course.
By?
As I said, by the end of September, Abqaiq will be at capacity.
And you were able to meet your shipments to international customers?
We are able to meet our shipment to international customers. When the supply was interrupted, we used our storage facility in Kingdom and out of Kingdom.
Meanwhile, global investor sentiment is down in dumps, according to Bank of America Merrill Lynch Fund Manager Survey. Darshan Mehta is standing by with the key takeaways. Darshan.
Yeah, good afternoon, Ira. And yesterday they published the fund manager survey for the latest month, and it seems that it's at this point of time it's a risk on off trade for the market. So basically what one of the key indicators that they have is the bull and bear indicator, and they say that that remains on the bearish side, and there is only modest improvement in the risk appetite for investors, and that is what their fund manager survey did indicated. So it's a risk off mode at this point of time. The other trend is that a little bit of good news coming in is that the cash levels dropped from 5.1% to 4.7%, indicating people are investing. There is a marginal pickup in growth expectation, but they are currently underweight on equity. So that's the negative point that's coming in on the survey. The other aspects was only 1 out of every 5 believes that short-term rates will go up. That is the trend, and it's coming from 1:10, which was there earlier. The other aspects of this survey does indicate that where are people putting their money in. So there is money that's in such a volatile market that is going into some of the defensive sectors and some of the growth sectors. So these are where money is going in. Where is money not going in? Energy and material stocks. That is something that is not going on. And most of them, 47%, believe that at close to $55 per barrel, oil is fairly valued. So that's the trend that the survey did manage to point out. Couple of other things, the contra bets that they have named in the fund manager survey. First of all, short US treasuries versus the stock. That's the first contra bet that they're recommending. The other one is long energy and materials versus defensive bonds. And third one is long the euro pound trade against the US dollar. So these are the 3 contra bets that the fund manager survey did point out.
Thanks for the Darshan. DHFL's resolution plan hasn't passed muster with its lenders. The creditors are said to be moving ahead with the contingency plan and are seeking the Reserve Bank of India's approval for it. That's according to sources. Vishwanath Nair now joins us with more on this exclusive story.
Right, Harsha. So, as you said, the Reserve Bank of India is being approached by this lending consortium for a plan that they have cobbled up together. Originally, DHFL had submitted a resolution plan which is allowed within the RBI's framework for resolving stressed assets. This plan involved paying up these retail depositors that they have, plus some small value investors up front at the interest rate that was originally clarified, but for the rest of the creditors, the payment would come in later over the course of 16 years. So that is something that the lenders were not happy with the plan, and therefore they made some tweaks. Now this final plan, as it has been submitted to the Reserve Bank of India, looks like this. Essentially, the company's loan book will be split into 2. There will be the healthy retail portfolio with about 50,000 odd crore worth of loans. Those loans will be housed under DHFL, and DHFL will be taken over by the lenders after they convert debt to equity. They will hold it under a holding structure. This holding structure essentially will act as a trustee for all the stake that the lenders hold. As far as the corporate loan book goes, that's about 35,000 odd crore. That portion is going to be converted into some long-term equity-like instruments, and essentially this will be held by banks, and they will be selling it to distressed asset investors. And this sale will happen at a discount, and the lenders are saying that they're going to make whatever provisions need to be made for this haircut. But what people who are in the know are suggesting is that the haircut could be in the range of 35 to 40%. Now, as far as the retail portfolio, which is going to be held by the banks, is concerned, banks are going to run it. They're going to appoint a fresh management for the company. Essentially, these will be bankers who already work with or are ex-bankers. Once they have the company running and lending, currently DHFL is not doing that. So once that lending business starts again, then the bankers could look for potential investors who will buy this company then at a premium, and thereby some of the recoveries may happen. Even with the distressed asset investors who are going to be buying the corporate loans, the lenders are considering that they will put in a clause in that contract. If these investors were to recover more than what is being projected, then some of that will be shared with the lenders as some sort of a clawback sort of an arrangement with these buyers.
Okay, a follow-up question. So they have approached the Reserve Bank of India, and one of the reasons for that is that there is no clear structure available for resolution of financial companies.
Correct. So in other situations, like for example a manufacturing company or any other form of a company, there is a clear mandate as to, there is an IBC, so that gives you a fair idea of how you proceed with the sale process or how you proceed with the resolution process. With respect to NBFCs, that doesn't exist. So obviously they need the Reserve Bank of India's blessings on this plan before they can actually move ahead.
Thanks so much for that, Vishnath. Manpasand Beverages promoter who is fighting to retain control of the company has questioned some of the decisions taken by the board in favor of the lender FinQuest. Yatin Mota is here to bring us up to speed with this very interesting story that's been playing out over the last few days. Yatin.
If you look at Manpasand Beverages, there is of course what you call a spat, or more than that, between the lenders, FinQuest, as well as the promoters. Now, what exactly has happened is that FinQuest Financial, which is a lender to the promoter as well as the company, had given loans of nearly 100 crore rupees. Against shares and securities, as well as had various agreements with relating to mortgage of their Vadodara land parcel as well as factory premises. So the lender, which is FinQuest, now controls or has a mortgage charge over the Vadodara land of the company, and not only that, they also have the entire promoter shareholdings pledged against their loan to the tune of 100%. Now, if you look at the recent a board meeting which happened between Finquest as well as Finquest director as well as the promoter Mr. Dhirendra Singh. Finquest and the directors, newly appointed directors, demanded a forensic audit of accounts given that there were various irregularities found, especially after various GST vigilance officers arrested one of the directors as well as the CFO. Not only that, Finquest also looked at exercising the call option on shares and securities to the extent of 50% of total promoter shareholding, which worked out to be little over than 22%. Now, Dhirendra Kumar, who is the promoter, alleges that the board meeting was reconvened without his presence, and the board was not authorized to carry out the board meeting since he was chairing the meeting and the board meeting stood adjourned. Not only that, he said that the forensic audit is not a part of the board meeting agenda, and also he said that he had no intention to sell his shareholding into the company via such call options, which was invoked by Finquest Financial Services. Now, we tried to reach out the directors of Manpasand. Not only that, we tried to call the promoters as well as the independent directors. None of them answered the calls. In fact, we managed to speak to one of the independent directors, Ms. Bharti Nayak, today morning. She also declined to comment on the entire issue. It's basically nothing but a tussle between the lenders who has a loan exposure of 100 crores, entire promoter shareholding pledge as well as land and building parcels pledged versus the promoters who now have a clear rift between the lender, which is Finquest Financial Services.
Fascinating story. That hold that thought, Yatin. The much anticipated meeting of the GST Council will be held this Friday on the 20th of September, and automakers are hoping for a tax break to help spur demand. But how much can a GST cut actually help in automobile sales? Kotak Securities has done a sensitivity analysis, and Yatin is here with the findings of that report as well. Yatin.
Clearly, the Fitment Committee as of now has rejected the demand for a GST cut on autos. It's up to the GST Council now whether or not to accept the recommendations on September 20th meeting. But clearly, the industry has been demanding, as well as the market has been anticipating, a GST cut for autos in order to aid sales as well as support the GDP growth. Now, what really happens according to Kotak Securities, if there is a 10% kind of a GST cut, the volumes for the auto companies are expected to rise 5% versus the previous expectations. And not only that, because of the operating leverage benefits, the auto companies, financials can drastically change if there is a GST cut. Of course, now Kotak believes that for the auto pack, the EBITDA could rise by nearly 6 to 11% to their previous estimates. And if you talk about the EPS or the net profit, that is also expected to increase by 5 to 13% for most of the auto companies. So that is a broad range in which Kotak does expect a positive impact of the GST cut. Let's look at company-specific data that we have compiled from the Kotak Securities note. If there were a GST cut of 5%, we could see the EBITDA for Ashok Leyland as well as Tata Motors change drastically to a level of 10% versus the previous expectations of Kotak. And if there were a 10% GST cut, the EBITDA for companies like Ashok Leyland and Tata Motors would rise sharply by 21%. Not only that, if you look at the two-wheeler pack also, the likes of Bajaj Auto and Royal Enfield as well as Hero MotoCorp, the EBITDA on absolute basis would rise by nearly 14 to 16%, respectively, to the previous estimates. Not only that, it will also have a significant impact on the earnings for auto companies. So if you were to look at the EPS change, if a 10% GST would come, then there could be a 26% jump in Ashok Leyland's earnings to the previous estimates. Also, if you look at majority of the two-wheeler and four-wheeler companies, the earnings would be impacted on the positive side by nearly 10 to 12% on an average, if at all there were a GST cut.
Yatin, thanks so much for that. Pranjal Bhandari, Chief India Economist at HSBC, has linked the NBFC stress to what's happening in the rural economy. She explains that the linkages between the NBFC sector, the construction sector and the rural economy are playing out in the incremental weakness that we are seeing in India. Let's hear her out.
A lot of people talk about the current slowdown in terms of like the cyclical versus structural lens, or the lens in which they say that, oh, it was a very unfortunate year, lots of things piled up, from NBFC crisis to volatile rains, to trade wars. But there's a third lens, which I think is very important, which has gone quite unnoticed. It is the interlinkages between the sectors of the economy. Some of it has strengthened more than people imagine over the last decade. Believe it or not, my analysis suggests that rural incomes depend a lot on shadow banks. And I'll tell you how. Earlier, about a decade ago, the main driver of rural incomes was agriculture. It was about 70%. Now it's fallen from 70% to about 50%. In the meantime, the role of construction in rural wages has really gone up. So if you look at construction, you find that about 70% of that is from real estate. And then if you narrow down on real estate, you find that it is very dependent on shadow banks. In fact, in FY18, 100% of the incremental credit of real estate developers came from shadow banks, not from India's commercial banks. So to cut a very long story short, until funding to real estate improves, I don't think rural incomes will really bounce back up in a big way.
So, the only question I had on that was that, so rural real estate, wouldn't things like Awas Yojana and, the spending there have supported, even though NBFCs may have curtailed their sort of disbursements? Isn't the NBFC sector more concentrated on urban real estate than rural? I could be completely wrong.
Yeah. No, so NBFCs, you're probably right that it's more concentrated on urban, but remember, the labor is a very freely moving labor. It's labor who spends a few years in urban India working on a real estate project, but when they don't have work, they go back to rural India, and when they build back in rural India, it's through the money they earned when they were working in real estate sector, which could have been in urban India. So we have very, very mobile labor in the economy. So that explains how urban stress can seep into rural stress.
Okay, understood. Also on the Awas Yojana and some of the other government programs, there always comes the question of state capacity, right? I mean, there is one thing to allocate money, but the state capacity to actually build out and take those projects further is also something that remains a question mark, right?
Yes, it does. So 2 points. One is that if you look at entire construction, 70% is real estate, driven more by the private sector. 30% is only infrastructure, driven more by the government. So even if the government gives a huge push to things like rural roads, yes, it will help, but it's a smaller story. The bigger story is the 70% which comes from the private sector. So the government can only help a little bit here. The second point is that, a lot of people are talking about fiscal stimulus, that, announce some big expenditure plans, but, it's not a tab that can be put on and put off at short notice. It requires a lot of on-the-ground implementation capacity, which is not very strong in India. So for example, something like Narega, you would imagine that it's a demand-driven scheme, rural distress is there, and therefore Narega demand would soar, right? But it's not. And I think one of the reasons is that the capacity of giving Narega by the states on the ground has come down over the last couple of years. So even if you announce big fiscal spending, I don't think it will really get in there.
The Federal Reserve, meanwhile, will announce its policy decision later tonight in a week marred by sharp swings in oil prices. So will the Fed cut rates for the second straight time? Kathleen Hayes reports.
Federal Reserve has made it very clear the past few months. They see the domestic economy mixed, looking solid, looking fine. It's the global risks that are rising so much. In fact, Jay Powell, when he spoke in Zurich a week and a half ago, the last time a Fed official spoke about the economy in public, the same mantra was repeated. He sees moderate U.S. growth, a strong labor market, counting on a solid consumer to keep the economy going. In fact, 2% GDP in the second quarter. You had nearly 5% year-over-year growth in consumer spending. Investment, though, down 6%. The trade war scene taking a toll on manufacturing, uncertainty causing businesses to pull back and not invest. Let's look at something that shows another aspect of this dichotomy. The white line is the Institute for Supply Management's Purchasing Managers Survey. Services, look how they've stayed in a healthy range, back up to 56.4. Manufacturing, the weakest since 2016, back below 50, signaling contraction. This is the problem. So, therefore, the Fed is seen making that 25 basis point cut because the global economy is slowing. The trade war is still going. The oil price spike, well, first of all, it's starting to fade. It would have to be a 100% spike to really correlate well with a recession, but it underscores the geopolitical risk, Brexit, Hong Kong, and more. This is why the Fed will do an insurance cut.
On to a Bloomberg exclusive. Howard Marks of Oaktree Capital says that he is now looking for opportunities in China. In an interview with Bloomberg Television, Marks said that opportunities to make money in distressed debt are never constant. Listen in.
Opportunities come and go. The opportunities to make money by buying distressed debt are not constant. In fact, they're the least constant thing I know about. We have a 31-year record. The result is pretty good on average. We've made the vast majority of our money in the funds of 5 years, and at the other times the opportunities recede. Everything is risky if you can't figure out what you're doing and you pay too much. The other thing is when there's too much demand, you can't get great bargains, and if you succumb and participate and pay too much, yes, then it's risky.
All right, so let's talk about where we are. Do you expect to see another 2008 type opportunity, which was one of the years that I imagine you're talking about, in the next couple of years?
I don't think we're in a bubble. I don't think we're going into a bubble comparable to 08. So there's no reason to believe that we'll have the panic that we had in the fourth quarter of 08 following the bankruptcy of Lehman Brothers, another global financial crisis. But, there's been a great deal of debt issued. There's been a battle to be the person who buys that debt. The battle has taken the form of bidding down the quality and the safety. So there's a lot of risky, aggressive debt that's been issued in the last 5+ years. And when that collides with a weak economy, I think there'll be great opportunities.
But not necessarily
right. There's the quantitative aspect of the amount of weak debt, and then there's the qualitative aspect of the amount of panic. And there's no reason why we should have that degree of panic again. People were talking about the end of the financial world 11 years ago. I don't see a reason to talk about that today.
So right now, there's a record amount of dry powder or just cash, I guess, or that's been committed to some of these mandates. And I'm wondering where you're seeing opportunities, even though everything has been bid up at this point.
Opportunities are very few today. I wouldn't even use the term seeing opportunities. Investing in distressed debt is a struggle today. The economy is too good. The capital markets are too generous. It's hard for a company to get into trouble. If they get into trouble, the capital markets are happy to bail them out. It's a struggle today, and it would be misleading to your viewers to talk about where there are opportunities. They're practically non-existent.
Well, does that mean that you're not investing?
Largely, yes. It's very, very hard to put money to work in distressed debt.
Would you rather than put your money in cash, or where do you put it instead?
Well, what we do is we don't call it. We form funds, people commit amounts of money to the funds, and we call it as we spend it. So right now, we're not calling very much.
What about China? You've talked about how there are opportunities there. Is that still the case?
Yes, I would say China is one of the exceptions. China grew on excess capital investment facilitated by aggressive lending from the banks and also non-banks. And I think they have big piles of NPLs, of non-performing loans that will not pay. And I think they want to recirculate that capital by getting those NPLs off the books. And we're very interested in being part of that process.
Howard Marks there. Out of time on the show. Thank you so much for joining us.